Good afternoon and welcome to the Noble Capital Markets Virtual Equity Conference. I am Joe Gomes, Managing Director and Senior Analyst at Noble Capital. Today I have the pleasure of introducing Steelcase Inc. Following the presentation, we'll have some time for Q&A. Steelcase is a global design and thought leader in the world of work. The company designs and manufactures innovative furnishings and solutions to help people do their best work in the many places where work happens. With us today from the company is Dave Sylvester, CFO, and Michael Mara, Head of Investor Relations. The floor is yours, gentlemen.
Thanks, Joe. Appreciate the introduction, and thanks to Noble for putting this together. We're looking forward to talking to the investment community today. Just real quick before I get started, just a reminder to the audience that we may use forward-looking statements and any non-GAAP financial measures. You can find the reconciliations in our IR presentation online. With that, I want to jump in. Steelcase believes that our investment thesis is that after several years of significant disruption, we believe modernizing the workplace will become even more important as we know organizations are seeking greater productivity, collaboration, and innovation. The way we break that down is we are an industry leader and we're in a changing marketplace. We think that gives us a great opportunity to grow our market share in what we focus on, which is large leading organizations that are focused on that changing marketplace. The second piece of that is that we have efforts to expand our revenue base. For us, that means our focus on expanding in our education, our healthcare, and with our small and medium business segments. The third leg that we like to talk about is we have an experienced management team and a conservative capital policy, which we believe provides stability, especially in changing and uncertain economic times. And lastly, I want to highlight that in our midterm targets that I'll cover, we do have a $50 million plus operational cost element of that, of which we've made some progress on, but there's more to come. So as I talk about some of the disruption that we've gone through over the last few years, I want to start with anchoring us on fiscal year 20. For us, that fiscal year ended in February of 2020, which was right before the pandemic began. And we finished one of our best years in 20 years. Where we did $3.7 billion and over 7% adjusted operating income. Obviously, the impacts of the pandemic were significant on our business. And you can see our revenue declined for several years as we were in different various stages of shutdown and disruption from the work at home movement. We also were experiencing significant inflation and supply chain disruptions, which started to stabilize from FY23 through 25, where you can see our financial results have returned to a different level. As we look at FY26, we've put out financial targets, which are mid-single digit organic revenue growth and improving our adjusted operating income. As we look back at FY25 and why we have confidence in those FY26 targets, we actually grew our incoming orders in FY25 by 4%, which included 6% growth in the Americas, which was largely supported by the work from home adjustments that many of our customers are making. Within that 6% in the Americas, we actually grew 12% in the fourth quarter, which set us up really nicely as we're entering FY26, as our beginning backlog is up double-digit percentages. And all that is in line with supporting the midterm targets we outlined at our Investor Day in FY23, which is mid-single digit operating income, organic revenue growth, and getting our adjusted operating income into the 6 to 7% range. So I talked about our conservative capital policy. This chart shows our liquidity profile on the bottom left, where if you look at our cash, our short-term investments, and our COLI, which is an asset that we have where we have the rights to the insurance policies on employees and former employees. That's the cash surrender value, which we can access as a form of liquidity. And that's actually higher than our outstanding debt. And the upper right chart kind of shows a net debt trend over time. And you can see in FY25, it's improved versus where it was, and it's starting to approach sort of pre-pandemic levels. So we're a respected leader when it comes to our global market share. We're leading, and we differentiate ourselves by the way we approach our innovation. You can see in the chart in the upper right, Steelcase about $3.2 billion, which outpaces some of our largest competitors. I talked about our global differentiation. So about 3/4 of our revenue comes for the Americas. About 1/4 comes from our international. We service that business through about 800 dealers. About half are in the Americas and half are outside the Americas. We have work life centers, which are showrooms in 16 countries around the world, which allows our different customers to access information about our products. And we manufacture what we call nearshore, which means we manufacture in the Americas for the Americas, in Europe for Europe, and in Asia for Asia. What that allows us to do is service our customers on a very localized basis. So we're available for them, whether they have a large project or a smaller need. The other way we differentiate ourselves is our approach to innovation. So we start from a basis of research. We do human-centered research about the ways people are working. We do it with our own resources, but we also collaborate with a group of independent organizations that are focused on similar trends. So institutions like Georgia Tech and Microsoft and MIT Media Lab. So we collectively gain insights into what's changing in the world, and then we apply those insights into our product applications to develop solutions for the workplace. So that research has helped us understand what people want, and I thought it'd be interesting for us to share that with you, that what we're hearing from employees as they are thinking about work is they want more individual privacy. So this was a trend that was actually happening before the pandemic, but as employees got used to different levels of privacy at home, they're requesting that as they come back to the office. So we're seeing companies respond with more levels of individual privacy. So think of screens and barriers and separation between employees. And that's a positive for us in the industry as it means a higher average selling price per workstation. They want spaces that support well-being. So this can be ergonomics, it can be collaboration, it can be informal sharing with your employees, your fellow employees. That has been a positive trend for the industry. And they want hybrid collaboration spaces. We all know that we're not all in the office together. And so the ability to connect with your, in a distributed way, whether you're in the office or part of the team is in the office. So we've been developing solutions to help with that. So our purpose is helping the world work better. We focus on serving leading organizations in the offices, in the learning environments, and in health environments. We do that through a number of brands, many of which are sub-brands of our larger Steelcase brand focused on health, learning, or small and mid-sized businesses. But we've also acquired several brands to help with that, help serve those customers throughout the years. So these are some of our smaller brands, which you'll mostly have come to us through acquisition. And we started sharing a few years ago the way that our revenue splits out by customer vertical market. So you can see in the pie chart on the right-hand side the size of some of our growth markets in small, medium business and in health. And the brown are more of our historical areas of strength, like large corporate customers. We see growth opportunities across all these segments, but see additional growth opportunities in some of the blue segments. So the way that we're trying to grow the business is through the way we're executing our strategy. So our strategy breaks down to leading the transformation of the workplace, expanding our reach within markets, and then strengthening our profitability so we can reinvest in the business. The transformation of the workplace. So we know as customers are looking to satisfy the way their employees want to work, we have an opportunity to lead there. And we think we can grow our market share in serving large corporate companies. And we've been able to do that over the last year or two. We believe we can become the most trusted partner in the new ways of working. Our customers look to us to help them understand how trends are changing and what they need to do in order to support their workforce. We can lead in product and application innovation, and we think we can deliver seamless work experiences by integrating technology in place. This idea of living on video and having enough privacy and having the acoustics and the lighting all work seamlessly is a big focus of ours. Our second strategy is expand our reach within markets. So we're looking to build on our strong momentum in education with Steelcase Learning. And that also includes continuing our growth in the K through 12 segment, which was bolstered a few years ago when we made an acquisition of a company focused on that called Smith System. We've seen great trends in the education environment, and we expect to continue that. We've also increased our focus on serving small and mid-sized businesses. These businesses were not as affected during the pandemic. They're usually in smaller cities and don't have as complex of real estate. And we've seen good growth in that business, and we think we can continue through more focus on that to serve that segment better. And we're looking to amplify our Steelcase Health business. This has been a business we've been in for quite a while. We've been trying to grow it organically, and we do think there might be inorganic opportunities similar to what we've done in some of the other segments. We just haven't found the right inorganic opportunity. But at the same time, we've been able to invest organically into a very strong market. Our third leg of our strategy is to strengthen our profitability and reinvest in the business. You saw from the earlier financial chart that our profitability had declined for a number of years. Some of that was due to the significant inflation we experienced. Part of overcoming that was capturing pricing benefits. So in our industry, we usually experience the inflation first, and then usually our industry is able to take pricing actions in order to offset that. It takes a lot of focus, and of course, the inflation was significant and extraordinary, but we were able to recapture that over the last few years. This has remained part of our strategy given the tariff environment that we're in right now. So we've had to implement additional pricing actions more recently to deal with the tariff environment. We also have an opportunity to optimize our operations. So we're pursuing $50 million plus of targeted operational cost reductions. So these are on top of the pricing that we've put in place, as well as any volume growth that we would see. So we feel we have an opportunity to adjust our cost structure by $50 million or more, of which we've made some progress over the last 2 years, but there's more to come in the future. We've also been involved in an initiative around business transformation. This is tied to a new ERP implementation for us. And so we're focused on both executing that ERP implementation, but also gathering savings as we standardize some of our operations to fit that new environment. And we think we have an opportunity to reallocate our investments towards our strategic priorities as we look to grow in some of these new channels more strongly. We know we need to reallocate investment versus make all that investment incrementally. So we've been working on different initiatives to take cost out of our existing businesses. When we think of capital allocation priorities, we think of it as a balance between reinvestment in the business, which has included acquisitions and is likely to in the future, maintaining a strong and stable dividend, and then opportunistically repurchasing shares minimally to offset dilution. If we look at our trends over the last 5 or so years, we spent about $100 million a year on CapEx and R&D. Our cumulative dividends, although we did have to adjust them a little at the beginning stages of the pandemic, have been relatively stable for the last few years as our profitability has stabilized. And we have made opportunistic share repurchases. At the beginning of the pandemic, we bought back quite a few shares. We bought less as our liquidity was challenged and our profitability dropped, but more recently we started to repurchase shares again in FY25. And you can see that we have a history of making acquisitions, including some that were made at kind of the depth of our profitability issues during the pandemic, which again is part of our strategy of keeping a strong balance sheet with a conservative capital policy. It allowed us to make those strategic investments. We talk about our growth strategy being tied to different opportunities in different customer vertical markets. Each of these acquisitions fit into a part of that strategy. So we found revenue synergies as we were able to make these investments because we were already focused on growing in these businesses, and these businesses were able to complement what we were already doing. So Joe, with that, I'm going to turn it over to you for Q&A.
Thanks, Mike. Great, insightful presentation. Let's go to the Q&A here. So let's start with why do you think you've been able to drive market share gains, and do you think that can continue?
Go ahead,
Yeah,
Vince.
absolutely. Okay, thanks. Yeah, so we have two reasons we think. One is just the base of how we always go about solving applications and product is from a basis of research. So as our customers have been looking for guidance and help and how to execute their strategies, how to bring their people back in the office, what needs to change in their office in order to support that. We have a basis of history and new research that helps supplement that. And we also, so that was one, just that's the way we always work with our customers. And when things are more complicated, like they have been the last few years, we think our value proposition actually connects really well with our customer base. We've been able to even serve and win new customers through this time frame. The second one is we've had a vision that the world of work was going to change. So although when we were at the depths of the pandemic and some of our profitability situations, we could have pulled back more as far as our investment goes, but we knew we needed to stay invested to continue to serve our customers. And we think some of those investments are paying off now with our as our customers come back to the office, our ability to serve them, and that's led to some market share gain.
Okay, and I'm going to kind of combine the next couple of questions. The return to office trend seems to have flatlined at rates below pre-COVID levels. So, kind of what needs to occur to see those rates rise? And what are you hearing and seeing from your customers about their real estate plans and furniture investments?
You have a lot in there. I'll take this one, Mike. First of all, I would say that you have to double and triple click on the data. The Castle Index, as an example, recently put out some Class A and trophy building badge in data, which suggests that they're significantly higher than the average. And that's really where our target clients sit. We're targeting leading organizations who value their space strategically and want to drive their culture and their strategy and innovation by having their people back in the office. I do think that there will a level of flexibility will continue to exist. People will have the option to work from home or third places periodically, which is why the offices need to transform in a significant way to support the hybrid transformation of work being more virtual and living on video, as Mike described earlier. When we look across our client base, it seems like each week of each month of each quarter, there are more companies that are leaning into more aggressive return to office strategies, in part because they're feeling the pain now of having been distributed for so long. So their strategy is not getting implemented as quickly or as effectively. Their innovation or speed to market is suffering. Their culture is not moving in a direction that they want it to move. Their attraction and retention and engagement of employees is falling off. And so what that's causing is the C-suite to start thinking about the office. And when the C-suite is thinking about the office, that tends to be a good driver of demand inside our business. They're thinking about it because they want their people back. Their people don't want to come back because they remember how the office was designed pre-COVID around density. They need more privacy. They know they're going to live on video. It needs to have more of a residential influence or feel to it, less corporate, more residential, because people have been working from their homes for the last 5 years. So the companies that are recognizing that are leaning into return to the office, and they're investing in transforming their work environments. And I think there's still much ahead of us and from a demand perspective related to all that.
Great. Thanks for that. And you got a question here. If the current administration is successful in bringing more manufacturing back to the U.S., do you think that would end up being a meaningful demand driver for the office furniture market in general?
Yeah, I saw that question during Mike's remarks. It's a good one. I definitely think that it'll be a positive factor if it's successful. So I'll stop short of sharing my 2 cents on whether it'll work, the tariff strategy, et cetera. I think it'll work to some degree in some places, and it will likely create white collar jobs or result in shifting some white collar jobs back to the US, which is where we play. And I think we'll benefit from that. Whether it's meaningful, I guess, is dependent on whether you think we'll actually have a meaningful amount of manufacturing moved back to the US. And I think that has to play out.
Okay. So let's stay on the tariffs for a second. What has been the impact of tariffs on Steelcase? I understand, you guys talked about putting some pricing increases in recently, but maybe a little bit more color on the actual direct and maybe indirect impact of the
Yeah,
on-off tariffs.
good question. 2, 3 years ago, when the supply chain was disrupted in a significant way, we made a lot of changes to our supply chain, which I would say even further moved our supply chains domestically. You got to remember, though, our industry is largely made to order with a high degree of specification and short lead times. So we, as an industry, and Steelcase in particular, are pretty regional in how we approach our manufacturing strategy. So less than 20% of our COGS in the Americas comes from outside of the region. But that's still pretty meaningful when you're dealing with the size of tariffs that the administration has put in place. So we've been attacking that on multiple fronts. One is continuing to look at ways to adjust our supply chain, and another is to put pricing actions in place. We're not alone. The industry is sourcing from, frankly, some of the same suppliers in different parts of the world. And so as those tariffs have been put in place, we've seen the entire industry put pricing actions in place, both surcharge, because we don't know if this is really here to stay for a longer period of time, or whether it's going to be more transitory, and more permanent pricing adjustments to the extent we believe, or our competitors believe, that it's going to be here for the longer term. So we're managing through it. It's a challenge. I'm more frankly worried about the compounding inflation that will come as a result. In the last administration, when he was president and put in tariffs, we saw steel prices go like this. We're already seeing increases in steel and aluminum today, and that will, put pressures on our business and potentially require pricing adjustments as well. The demand impact of all this, the uncertainty that tariffs is creating, is also a good question. We're not anywhere near a peak from a volume perspective. I think our volumes are still more than 30% lower than they were pre-pandemic. So we have the forces of companies bringing their employees back to the office and recognizing they need to change, with the C-suite engaged in thinking about their workplace strategies. So I don't know if we're going to see a significant demand impact from this uncertainty. We actually might find our way through it and continue to grow despite the uncertainty. But there's a lot of moving pieces, that's for sure.
Thank you for that. Now, the international business has been challenged lately. Can you tell us a little bit more about that and what you're doing to get it to profitability?
Yeah, it's, again, if you double click on international, there are certain parts of the market. India is a great example, Iberia, Middle East, that's doing extremely well. But there are other parts of the market, China for obvious reasons, and Western Europe for macro reasons, that has been more challenged. China feels like it's bottoming for us, and that we could be starting to see growth off of a deep bottom in China, which will help our Asia Pacific business, as long as India also continues to stay positive. And in Europe, we have actually seen nice growth from our largest corporate customers, who are really pushing to get their people back into the office. But we've been challenged in our smaller to mid-sized part of our business, which is a big part of the European business. That has been suffering, we think, more because of the broader macro environment. So what we're continuing to do is look at ways to reduce our cost structure, and we've been doing that, and we are continuing to do that in Western Europe.
So you've driven some nice gross margin improvement over the past several years, despite the revenue being relatively flat. Can you give us some insight as how you were able to do that?
Yeah, our margins in the 21, 22, I guess, time frame, calendar year 21 and 22, were significantly challenged by the inflation I mentioned earlier. And in our contract business, it takes a year to two to get pricing in place. So we had the inflation that drove margins down, and then we had the pricing benefits that were negotiated in that caught up to the inflation, and therefore helped show the margin improvement. So that's just kind of the timing of pricing and inflation. But what we've also been doing is driving this $50+ million target that we have to improve our operational performance, which is really about looking at our broader footprint. And on our quarterly analyst calls, our CEO has been talking about a number of things that we've been doing to modernize technology that's reducing footprint, reducing inventories, improving flow, as well as shrinking our distribution network and optimizing it in further ways. And we've, of course, been looking at our overall manufacturing footprint as well. So all of that has been contributing to our margin improvement.
And let's wrap up with this one. Can you provide some color on your efforts to penetrate other end markets, such as the healthcare, education, and small to
Yeah,
mid-sized businesses?
SMB, small to mid-size, has been a benefit for us with a little bit of emphasis. When large companies reduced demand during the pandemic, we increased emphasis and support of our dealers on small to mid-sized business, and we did fairly well. And what we also realized is with a little bit more investment, a little bit more targeted incentive with our dealers, we could regain some share of wallet that was really we were losing on small to mid-size. So we see opportunity for growth in SMB, and in education, we've done really well with our Smith System acquisition, and higher education has also been positive. I think with the DOGE efforts and some of the pullback on funding from the government in higher education, that could impact kind of short-term or midterm opportunities in the education world. But the fundamental reason of why we're there, which is educational spaces need to change to recognize how pedagogy is changing, that still exists. So we're staying invested in that vertical. And healthcare is a similar reason. We've got good demographics with an aging population that is putting a lot of pressure on healthcare. And so while we've always done well on the administrative side, we see an opportunity to grow in the clinical side, and that's where we've been investing and growing.
Great. Well, Dave and Mike, we've come to the end of our allotted time. We covered a lot of ground today and got significant insight into what Steelcase does, its markets, and opportunities. We appreciate you taking the time to participate in our conference, and we wish you and the company the best in the future. Thanks again.
Thanks, Joe.
Thanks, Joe.